Hey traders, welcome back to the channel and welcome back to another weekend video. Over the weekend, Iran's head of parliament stated that Iran has prepared a mechanism to manage the traffic in the strait along a designated route. And at the same time, he stated that this specific route will remain closed to the operators of Project Freedom, which is obviously going to be the Americans and the Israelis. And for now, we are already seeing some of its impact on the weekend financial markets, like for gold. Gold prices right now are trading around 45.30s. They are moving lower on this escalation on this renewed supply disruption fears. For reference, if we see the gold prices around the Friday market closed, they closed around 45.40s. So based on this escalation, based on these renewed supply disruption fears, gold prices are already moving lower. We are seeing some upside in the oil prices on the weekend markets as well, and we are seeing some more downside in the indices as well on the weekend markets. Now, in this video, we will be discussing the current Middle East situation, how it is impacting the markets, and possible trade plans going into the next week, my current trades and the trades which I am looking for the next week based on the current fundamental picture and the fundamental picture which can form ahead going into the next week. We have a lot to discuss, so without any further ado, let's just start. Now, before starting, just a little overview of the current Middle East situation, what happened over the last week and how it is impacting the markets. Last week, around the weekend, America sent a proposal to Iran, and in response, Iran rejected that proposal and sent a counter proposal to the US, which eventually got rejected by the US as well. So, what this eventually did is that this said to the markets, to the market participants, to the traders, to the investors, to everyone that there are no success in the talks between the US and between the Iranians. The strait is still going to remain closed. The supply disruption fears related to the oil are still going to remain present. Obviously, the strait manages around 20% of the global oil supply. The demand is still there. The demand for this 20% is still present in the markets, but the supply has been halted due to the current Middle East situation. And due to that, obviously, as the demand is elevated but the supply is not enough to meet that demand, we are seeing higher oil prices. And these higher oil prices, they are feeding directly into your inflation. They are causing upside risk to the inflation. They are causing more upside in the real yields, in the bond yields. They are making the dollar stronger and eventually putting pressure on non-interest yielding assets like gold, like silver, and putting pressure on risk assets like the indices and the crypto market as well. This is the overall situation. This is the overall overview. And over this weekend, we saw this narrative getting more concrete with the Iran's head of parliament situation. With the statement by the Iran's head of parliament, he emphasized that Iran still has control over the strait and they are not going to open it until obviously the war is ended, until their demands are met, stuff like this. So we have a concrete narrative in the markets that the strait is going to remain closed. The supply disruption fears are going to remain present in the markets. Oil prices can very well remain elevated for longer, and inflation expectations can continue to rise. The bond yields can continue to rise. The real yields can continue to rise, and we can see continued pressure on the gold. We can see continued control pullbacks in the indices as well. This is the current narrative which has been happening in the markets. And to be very honest, this doesn't need anything new. Okay, I argued about this in the last week, maybe, or maybe a week prior to that, that this all of the situation, it doesn't need anything new. It just needs nothing to change eventually, because if nothing changes, if the strait remains closed, then the supply disruption fears related to the oil will remain present in the markets. The strait will remain closed. The inflation fears will remain elevated. The bond yields, the real yields, they will continue to rise, and they will continue to put pressure on the gold prices. They will continue to put pressure or limit the upside in the indices and limit the upside in the Bitcoin prices as well. This story which we have right now, this needs nothing new. All it needs is nothing to change, and that is exactly what we are seeing in the financial markets. But as traders, we have to remain adaptive. Obviously, we have to remain adaptive to the market conditions. We have to understand the pattern, because everything, even with the fundamental picture, even with the current macro picture, has a fundamental pattern, has a pattern of how this game is being played. And I argued about that pattern last week in my last week's YouTube video as well, and I'm going to repeat that pattern. On weekends on weekends when the markets are closed, you are not going to see any major optimism. You are only going to see escalation. And on weekdays, you are not going to see any major escalation. All you are going to see is optimism. Okay, this is how this game has been playing. This is the rule of the thumb for this geopolitical situation. This is what has been happening since the very start of this war, since the very first day of this war. Now obviously, based on this, we can form a trading plan as well. If during the weekdays we are going to see optimism, if during the weekdays we are not going to see any major escalation, then that can suppress the oil prices. That can maybe bring some pullbacks, bring some downside in the real yields, in the bond yields, and that can bring some upside during the week, during the initial half of the week, in gold prices and in indices as well, before the reality check hits, before they realize that the strait is still remain closed, the optimism is fake, and then they continue lower. This is the pattern of this war, and this is what has been happening since the very first day of this war. Now based on this, obviously we are going to form our trade plans. Now, with this recent escalation, with this recent news that Iran has prepared a mechanism and the operators of the Project Freedom will not be allowed, and with this recent renewed supply disruption fears, if nothing changes, if Iran does not come and maybe take back the statement, or if we don't see a major type of optimism during the weekend before the market opens, for the Monday, for the weekly market open, then we can see some gap ups in the oil prices and even some continuation. I believe before any downside going into the next week, before we see any downside in oil prices, before we see any, you can say, fake optimism in the markets, before we see any manipulation type of attempts by Trumps or by OPEC or by their allies, by Israel or whatever, before we see, or by Axios even, okay, because Axios has been the highlighted one recently, by Axios even, okay, before we see anything like that, we can see oil prices filling this week around the $110 per barrel level going into the first half of the week. And obviously, we can very well see a test of around $112 per barrel level as well going into the first half of this week before we see any type of fake optimism. Now, obviously, the fake optimism will come. They can't uh, you can say they can't bear as elevated oil prices as they are right now. They can't bear, especially the Americans, especially Trump. He can't bear as elevated bond yields as they are right now. That is why some type of fake optimism will come. But before it comes, we can very well see oil prices testing $110 per barrel level or $112 per barrel level before we see any type of fake optimism causing a pullback. But obviously, that pullback will be very well a buying opportunity as well, around the around $100 per barrel level, or maybe even lower, around the 96 $95 per barrel level. Now you have to understand that as long as the strait is closed, any pullbacks, any profit takings in oil prices are going to be a dip buying opportunity. Okay, so you wait for pullbacks during the week, you wait for fake optimism, you wait for attempts to suppress the oil prices, you wait for the manipulation, and then when you get that manipulation, when you get that fake optimism, you will go and simply buy those dips in the oil prices. Now, to be very honest, I'm not in currently oil buys or any type of trades right now on oil. I am waiting for this zone going into the next week, and I will see, not specifically the zone again, around the $110 per barrel level and around the $112 per barrel level. I am specifically waiting for this zone to look for any type of fake optimism, any type of attempt or any type of manipulation to suppress the oil prices. And if we get that from around the zone, then we will very possibly, obviously, will get a pullback as well. We will get a pullback to, you can say, kind of trap the late buyers or to trap the sellers, anything like that. Okay, but obviously at the end it will be a manipulation tactic, it will be a tactic to suppress the oil prices and nothing more than that. But on the other hand, if at that time the strait will remain closed, then this will only be become a dip buying opportunity. So in that case, I will be looking at the $96 per barrel level, this daily demand area, which also aligns with this overall trend line, which is overall higher time frame structure, where I will be looking for some buys as long as the strait remains closed, targeting again the 110 and $112 per barrel level. Now, based on the narrative which we just formed, we can understand the movement in the initial half of the week in the gold prices as well, in the indices as well. Now in the initial half of the week, if nothing if before the market opens, if we don't see any major optimism, then we can very well see oil prices heading into the zone around the $112 per barrel level. Now obviously, if we are expecting oil prices to rise initially at the start of the week, then we are expecting gold prices to move lower as well, right? We are expecting gold prices to move lower as well, and I'm looking for gold going into the first half of the week to test around this demand area around the $4,400 per barrel level on that daily time frame. Right now, if I can show you, let me try to show you it. I am currently in some shorts on gold. Now last week obviously I was in bias from somewhere around this zone, but I booked some profits, I booked some losses in this overall range. Overall I ended at around a little over 1% in profits from all of this range, all of this ranging zone. Okay, it could have been much better, but obviously it is what it is. And after that, once we broke below this demand area, support area, whatever you want to call it, once we broke here on Thursday around, I believe I took some sells on gold, and right now I am targeting around the $4,400 per barrel level on gold prices. Why? Obviously because of the narrative which I just told you, because of the expectations by me that oil prices can very well test the 110 and $112 per barrel level around the zone before moving lower. So if I am expecting oil prices to move higher, then obviously I am expecting at the same time gold prices to move lower as well. Why? Because if oil prices rise, they will feed into the inflation fears, they will elevate the real yields, they will elevate the bond yields, and that would put pressure on the gold prices, right? That is exactly why I'm looking for some downside in gold in the initial half of the week before I look for possible buys on gold, possible day trade buys on gold from these two zones. One is demand area sitting around the 4380s, 4360s, and the second demand area for me sits around the 4320s, flat 4300, something like that. Now the plan is again based on the movement of oil, because oil is the one which is feeding into the inflation fears, and then those inflation fears are feeding into the bond yields and the real yields, and then that is what is moving gold, is moving the indices, is moving the dollar, right? That is why we will start from the very first point or very first part of this whole picture, of this whole narrative, which is going to be the oil prices. Now as initially in the first half of this week, or initially I'm expecting oil prices to move higher, that is exactly why I'm expecting gold prices to move lower as well. And after that, around from 112 or $110 per barrel level, I am expecting some fake optimism because of the pattern of how this war has been going. Okay, because we always see some optimism during the week, during the trading week, to suppress the oil prices, to control the stock market, uh, to control the bond yields, to control the real yields, right? That is exactly why, based on that pattern, based on the pattern of this war, I am expecting some downside in oil prices from this 112 or $110 per barrel zone. And obviously, if I am expecting some downside in oil prices going into the second half of this week, probably, then obviously based on that, I am expecting gold prices to move higher as well going into the second half of this week. Again, why? Because if oil prices will move lower, the inflation fears will move lower as well, the bond yields, the real yields will move lower as well, the dollar prices will move lower as well, and obviously that would help the gold to get stabilized, to give us some upside or higher moves. Okay, this is the pattern, this is the thing, this is the narrative. Okay, that is exactly why right now I'm short. I'm expecting some downside in the initial half of the week, and going into the second half of this week, I am looking for some buys on gold going into the weekend. Obviously, I will be closing before the weekend, so if we see any major escalation, I am on the safer side, right? So this is my plan on gold. And after that, on indices, I have something else to tell you about as well. We will see if we are going to discuss in this video. For now, let's just talk about a little bit about indices. Now, one thing is clear, that the rally in indices is very strong, and it is majorly driven by the AI hype and the AI driven productivity, according to the Kevin Walsh as well. AI driven productivity can very well digest the inflation, and the members, the participants, the investors, the traders, they are greedy as well. They are greedy as hell, right? They don't want to miss the AI hype. They don't want to skip the AI hype. That is why the dips on indexes remain buying opportunities. As long as you don't see a new form of major escalation in the Middle East situation, then you will get nothing on the indices but only controlled pullbacks, or I would say controlled buyable pullbacks that you can eventually buy. Right now, obviously, we are seeing some sort of a pullback on the US indexes, but it's nothing. If you see this overall rally, like if we see and if we try to market, this is, I believe, around a 20% rally. Yeah, so this was around a 20% rally, and after a 20% rally, only after a 20% rally, you are getting a 1 to 2% pullback. Okay, and to be honest, even with this 1 to 2% pullback, I think it will be very well be bought eventually from around this zone, from around this fib golden zone, after it becomes around a 3 by 4% pullback, right? This is the area. So I'm looking at this fib golden zone. It uh yeah, it is a golden zone on the fib. It is a beautiful demand area on the H4 time frame as well. Beautiful small type of accumulation area, demand area on the daily time frame as well. So I am expecting, as I told you in the very start of this video, that I am expecting oil prices to move higher in the first half of this week. And obviously, if the oil prices are going to move higher, then they can put pressure on the indexes as well, from the real yields, from the bond yields, from the higher interest rate expectations. And obviously, due to that, I am expecting initially in the first half of this week indexes to continue a bit lower before we eventually see buyers stepping in from around this zone, around the 7280, 7240, something like that. And that would be my buying opportunity. I will be looking for some buys on indices. My first targets will obviously sit around the previous all-time highs, around the 7480, 7500, something like that. So this is the simple plan on the indices. Okay, this is my buying zone. If no new major escalation happens, then obviously I will be looking for buys around this zone based on the narrative which I just explained to you for gold as well. Obviously, I'm running, or everyone is running the same narrative everywhere. Okay, because everything at the end is tied with the oil prices, as oil prices are the ones feeding into the inflation, and then inflation is feeding into the bond yields, the real yields, the dollar prices. So everything is tied right now with the oil prices. That is why they are the most major factor right now, and you will need to keep an eye on them. After that, I have copper. I'm looking for some buys on copper, some swing trading buys on copper. Now about copper, it is mainly a supply demand trade. We are expecting, if you do your research now, if I try to explain it here, it will become a very long research, but in very short, copper is expected to go into a supply deficit going into 2026, by the end of 2026, and that deficit is expected to last for the next 5 by 15 years. Obviously, the demand has been rising from AI data centers, from EV vehicles, all of the stuff. The demand has been continuously rising, but not enough supply is present in this market to meet that demand. Okay, and obviously we have a lot of copper in the world, but you need to extract it. You have to set the refineries, you have to refine that copper to become usable, and that is a process which take years, right? Right now, exactly based on this factual data, copper is in a deficit. The supply of copper is in a deficit. The demand is continuously rising based on because of the AI data centers, because of the electronic vehicles, all of the stuff, and not enough supply is present in the markets to meet that demand. This is the simple economics principle, that if the demand is rising and the supply is not rising, like relatively to that, or the supply is moving lower, or the supply is not able to meet that demand, then the prices will eventually rise. This is the simple economics principle, and based on that, I am looking for some swing opportunities on copper, some swing buying opportunities. This is the overall structure. The my current buying zone aligns with the Fibonacci golden zone as well, and I'm looking for some buys around the 13,200, 13,280, something like that. If we see a test of that next week, I will be very willing, very well looking for possible swing buys on copper going into the next week. So these are my trade ideas. This was my narrative and everything explained to you. And this was pretty much it about this video. I had something related to the Kevin Walsh as well, related to the preferred inflation measure of the Fed, based on what Kevin Walsh said. I wanted to talk about it, but maybe we will talk about it in a separate video, as right now this is not a part. This was only a preparation for the next week, and in this video we have talked about everything, the fake optimism which we are expecting right now with the situation of the Middle East, how it is impacting the markets. We have discussed everything related to the next week. About the economic calendar as well, no major data is expected next week based on the economic calendar. There is no major data, right? So we have discussed almost everything for the next week. We have prepared. I have shared my trade plans with you. If you have any questions, you can ask in the comment section. And for macro ideas, trade updates, and all the stuff related to that, you can join our public Telegram or even follow our account on X as well. I will drop the relevant links in my description. Best of luck for the upcoming week.